Hello everyone. I guess lots of people have joined. Can you all hear me?
Hello, Sajid, I can hear you well, and I think we should start now. Thank
Okay.
you, Mara. Thanks for confirming. So, thank you, everyone, and welcome to yet another webinar of by Steflar, Mastering FRM. We are a preparation provider for FRM certification, and my name is Muhammad Wes. I am the Chief Content Officer and FRM coach and trainer. So we are so pleased to have Mr. Sajid Iqbal with us. Just a very brief profile before we officially start. Sajid has been working with risk management for a very long time. He is an MBA by profession and also pursuing a FRM certification. Um, then he was initially head of treasury at one of the leading banks. He is currently a deputy CRO in one of the leading bank in the UAE. He has a lot of experience in the market and liquidity risk domain, and that's where the LIBOR comes in. So, since it is a hot topic and everyone is so much confused about this topic, to be honest, including me, sitting in Pakistan, you do not have a lot of updates about how it's going globally. So we invited Sajid to share his views about the LIBOR transition, as he is part of the committee that is overseeing the LIBOR transition in his organization. So before waiting further, let's move on to Sajid. Over to you. You can start your presentation. Just one thing that we'll be taking questions as well. So during this session, if you have any question, you can just keep writing. And if it could be relevant, I'll keep asking Sajid the questions in between, and we'll have 5 minutes reserved for the question answer session as well. So it's a 1 hour long session. We will leave some time in the end to have some question and answers. So Sajid, over to you.
Thank you, Wes, and thank you for inviting me on this very important topic. And it's really delightful for me to sharing a space with you. And hopefully, I will be able to explain it in very simplistic way, so people uh, can rid of their confusions. Okay, so without wasting any further time, so we'll start. Uh, so if everyone can see the screen, so just confirm me once, so I will going forward, I will not be bothered about it.
Yes, it's visible, Sajid. That's fine.
Yeah, okay. So today, briefly, because it's a very complex and comprehensive topic, and it requires a lot of background understanding about banking and their products and how they operate. So I have tried to summarize every little aspect, but definitely 1 hour is not sufficient to understand each and everything. But the main point of this presentation is to explain the concept in very simplistic way that you can have at least the overall idea what's happening in the market and what is LIBOR and how it is affecting the markets. So it's just a idea, and then I can give you an example that if you are standing on top of the mountain and you can see a lot of ways going around, you can see all the ways, you can see all the paths, but to move towards a particular path, you need to follow that. So this is just a bird eye view, you can say, uh, to the very important and very complex subject in the financial industry right now. So just to have a basic understanding and knowledge about it. So before we, start the LIBOR thing, so I have a very interesting thing to share with you. That is the history of LIBOR. And why I'm saying it's interesting because uh, I'm not going to share the whole story with you, but if you go on the websites and there are a lot of articles, if you need, I can give it to you and you can read it. It's a very interesting story how it's started actually. So, so this is about the actual where the LIBOR started from. So before we move into the history and how it started, just let me give you a brief about brief concept about the LIBOR transition, what is happening right now. So uh, a decade ago, it became clear that LIBOR uh, partly reflected creative writing by money traders at major banks. So creative writing, I'm using this word specifically. So it did not reliably or precisely reflect the actual market condition for borrowing and lending. So the regulators and industry organization decides LIBOR was broken and the market should move away to something better. Hence, we began a multi-year and surprisingly complex exercise. But before we go into LIBOR transition detail, um, again, I'm coming back to the history. History always tells you about the crux of all the problems in today's environment and where they have started from. This man in picture you can see, his name is Minos Zumanakis, was running the newly opened London branch of Manufacturers Hanover, also known as Manny Henny as a nickname. The bank organized one of the first syndicated loan, the $80 million loan for the Shah of Iran, which is which was pegged to what Zumnakis called a London interbank offer rate later on, and that was in 1969. So this is how it started actually, and the ambitious bankers of that era had little idea that the rate they were using to price these loans would become a central cog in global financial system, and it would become a benchmark for $550 trillion in contract ranging from interest rates derivatives to home loans to credit cards and many other products. You can name that. So 4 decades onward, the rate has been discredited by the present attempts of traders to game it and by the banks that have uh, lied about their true cost of borrowing and by the regulators accused of either condoning or failing to stop manipulation. So I think enough history for today's session. And if you are interested to know more about that history, then let me know. I would gladly share the article and news about it. So moving forward, so now we know that what is uh, LIBOR, and then we can now dwell into how LIBOR works. So I will now quickly touch the mechanism of LIBOR rates. So in earlier days before the great scandal of 2012, as I mentioned, London Interbank Offer Rate was also known as BBA LIBOR, which is British Banker Association. But because BBA involved in scandal, as you read in the previous slide, when it was found to be guilty of interest rate manipulation. So therefore, to eliminate the bad memories and put a fresh face on things, BBA LIBOR was renamed as ICE LIBOR, which is Intercontinental Exchange. So ICE LIBOR is same as we call them LIBOR. So getting back to the mechanism of LIBOR and how it works. So LIBOR rates are mere benchmarks instead of a tradable rate. So therefore, throughout the day, banks may trade at different rates than the LIBOR rate listed early in the morning, usually 11 a.m. in London time. The maturity period of these rates may vary from single day to a stretch of, let's say, 12 months. So overall, LIBOR comprises 7 maturities quoted for deposit of each of 5 currencies. Um, you can see Swiss franc, euro, pound sterling, Japanese yen, US dollar. And to produce these 35 rates on every business day, the ICE benchmark committee maintains an administration panel of between 11 to 16 banks as contributor. The process of setting interest rates begins by asking the panel banks about the rate which they are willing to lend to other financial institutions. Usually this occurs early in the day, well before the officials are for publishing benchmark rates. After they provide their desired rates, the contributions are listed in top to bottom order, like top-down order. So outlying quotes are eliminated by removing 25% of higher and lower quotes. And then the remaining rates are average and rounded to 5 decimal places. So this process is repeated across 5 currencies for each maturity, sorry, to produce a total of 35 LIBOR rates. So moving forward, um,
Sajid, to just explain what is the difference between this BBA and ICE LIBOR, if you could just briefly explain.
So, okay, let me get back to the original slide where I've mentioned it. Basically, when it was started in 1969, uh, so if you want to go into more history details, so at that time even this person has started quoting the LIBOR rates and in collaboration with other banks. So basically, the first product was syndicated loan, which was issued to Shah of Iran. So they have colluded, I would say colluded, because there were few of the banks who were involved in that, and they have issued those loans based on certain interest rates. So at that time, the British Banker Association found that this is not the good practice, and there might be some manipulations. At that time, even they were worrying about the manipulation. So they took over the charge, and then onward it was called as British Banker Association LIBOR, because it was administered by the British Banker Association. So in 2014, after this debacle happens about LIBOR, so they just changed the name, and now the administration name of it is ICE, Intercontinental Exchange. So hope this clarifies.
Okay, great. Yes, thank you, thank you. Yes, yes, it's clear now.
Okay, now the moving forward, I mean, this slides shows the volumes we are talking about in the financial market. Uh, yeah, sorry. Yeah. So to understand the transition, it was required that you must have an understanding and knows a little history about LIBOR. Therefore, I have tried to touch upon it very briefly. So in this slide, you can see what we are talking about. We are talking about syndicated loans, business loans, retail loans, floating rate notes, securitizations, OTC derivatives, exchange traded derivatives, deposits. And on the right side, where you have color coded boxes, you can see the size of these outstanding contracts. So the more dark areas are above $1 trillion in terms of size. So you can understand the magnitude we are talking about, and that is why the whole financial industry is very worried, and rightly so worried about the transitions happening. So we'll touch upon the why we are transiting, because we know there's a problem in on July 17, 2017, the UK Financial Conduct Authority (FCA) announced that after the end of 2021, it will no longer compel or oblige panel banks to submit the data on which LIBOR is calculated and set. So because now LIBOR is going to end, and why it is ending, that we just went through a very brief history, and now we know that because of this problem, this manipulation problem by the panel banks, we have to have a transition. And then if we have to have a transition, these all outstanding, humongous outstanding contracts needs to be replaced by something not similar even, but very comprehensive kind of rates. So we'll touch upon that in later slides. So moving on, this slides actually shows you the timelines, and important events happened during last 6 to 7 years in response to LIBOR problem and transition. So actually I have taken this snapshot of timeline from a little older source. So some of the events have already happened and announced instead of saying them expected. For example, ISDA LIBOR protocol is already effective from 25th of Jan, and FCA has already confirmed the cessation of all LIBOR rates by 31st December 2021, with the exception of dollar LIBOR, which will cease to exist after 30 June 2023. So I will come back on this in later slides on this very important differentiation between other LIBOR rates and dollar LIBOR rates cessation. But mainly it is because dollar LIBOR exposure is humongous, and it needs some good transition time to mitigate the systematic risk in financial markets due to non-existence of dollar LIBOR rates. And even as you know, by knowing the history now, that it was started with the dollar based loans only. So now the dollars has been and have been the top volume rates. So okay, so moving on, now we have talked about the transition and why we are going to transit because of the manipulation. So we need to understand that we need to know that why LIBOR need a transition, and we also need to know what will replace the LIBOR, and will it be like solution, or how it will behave post LIBOR era. So these are, and many other questions are still do not have complete answers, but there is at least a certainty that LIBOR rates have to discontinue and some other rates would replace them. Again, I have taken this table from BI's Basel published document called Beyond LIBOR, which is a premier on new reference rates. And it's actually a very good document to understand the future of new reference rates. So if you have time and if you have interest, you can go to the Basel website and you can download this paper and go through it. And even according to that Basel document, authorities have already taken steps to identify and construct alternative risk-free rates, which are benchmarks compliant with the standards such as IOSCO principles. So 5 of the largest currencies areas have already moved to overnight benchmark rates as a backbone of new regime, as you can see in this table. And you can also see that what are the replacements or actual words for it. We use it as alternative reference rates. So there are 2 terms you can see in this document. One is risk-free rate, and other term is alternative reference rates. So risk-free rates means there is no risk component added to that rate. That's why we call it risk-free rates. But because of LIBOR transition, now the new term, which is used by all the banks and institutions, which is alternative reference rate. And you can also understand that who are the administrative bodies of these rates, and what are the data sources of these overnight rates, and where these rates are coming from, who are using these rates, and are they secured or unsecured rates. When we see out of 5 rates, only 2 rates are secured, and 3 are unsecured rates. And when we say secure rates, this means that underlying transactions are repo-based transactions. So repo means that there is a collateral in form of US Treasury bill, and similarly the other way around is unsecured rates, and which is based on money market transactions. You know, money market transactions are clean lending transactions. There is no collateral involved. But that is how these rates are constructed, and now this being selected as the alternative reference rate in replacement to LIBOR. So moving on, this is another table. I mean, I have just shared this because it has interesting information just to understand.
So Sajid, just to confirm, we will have different rates in different regions, which will be replacing LIBOR.
Yeah. So like I said, that there are right now 5 currencies left, which are quoted in terms of LIBOR rates by the panel banks. So there were initially, as a history says, that initially started from dollar, then comes the British pound, and then other rates came into the picture. And then at one point in time, it was like 7 or 8 currencies where the LIBOR rates were quoted in those currencies. Now we have only these 5 currencies remaining in this regime, and where the LIBOR rates are quoted. So every currency, I mean, quoted by 11 or 16 panel banks based on their expected interest rate in future.
Okay, all right.
Yeah.
Good.
So definitely dollar belongs to America, and British pound belongs to UK, and Swiss franc belongs to Switzerland. So accordingly, each country is looking at, because now LIBOR is finished, so LIBOR is no more. So there's no central place to publish those rates. After 31st December 2021, there will be no rates published by these central administrative bodies like ICE, benchmark administration. So every country has to come up with their own risk-free rates, or you can say alternative reference rate, so they can price their loans or deposit, whatever, in their respective currencies in their countries. And same can be followed by the other countries in in the world, where they want to price a dollar specific loan or dollar specific lending or funding or whatever. So that is how it is working. So every country has to come up with their own risk-free rate. So one little clarity I would like to give it here, like in Pakistan, we have Pakistani rupees currency, and the benchmark rate we use is KIBOR, which is Karachi Interbank Offer Rate. So similarly, every countries have their own local currency benchmark rates. Like in UAE, we have dirham, so we have Emirates Interbank Offer Rates. And similarly, if you go to other countries, they have their own local currency benchmark rates or reference rates. So that is there for those local currency. But for these 5 currencies, there was a mechanism, like I've explained to you. There is a administration body who are taking quotes from 11, 16 banks based on their judgment and then quoting it for everyone to use it. So now it has become a practice in the last 30, 35 years that banks are using these rates because it's easy to follow and it's a market accepted practice. Everyone follows that, and all your foreign currency loans or facilities, everything is based on these rates. It's very easily accessible by the banks, and they don't have to put their own mind into figuring out what rate they should quote. So that is how it is. Okay, moving forward. Now we'll come to, we already know that what is LIBOR and how it is calculated. And I have also shown you the alternative reference rates and what are the rates has been selected for each currency. So now we know that there are risk-free rates, which we also call them alternative reference rates in LIBOR transition perspective. But question is, are these like-to-like rates? Means, can they simply replace the LIBOR rates without any tweaking? And the simple answer is no. And to explain this, let's understand what are the differences and what pieces are missing from risk-free rates or alternative reference rates. The first component which is missing from ARRs is the term structure. So because LIBOR is forward-looking rates and ARRs are basically overnight rates, as you've seen in previous slides, that these are overnight rates based on actual transactions. So because this means that calculation of like if you want to calculate 3 months or 6 month rate based on these ARRs, it requires significantly different mechanics to do those based on LIBOR. Like LIBOR, you just can quote a 6 month rate out of screen, and you can quote 3 months rate out of screen, which is already calculated, published. But to have a replacement through ARRs, now you have to have a mechanism behind it, and therefore that's the reason that there is no term structure right now with respect to these alternative reference rates. The second component which is missing from ARR is the credit component. So as you know, the LIBOR is forward looking, so that's been quoted by 11 or 16 banks, and they have inputted their judgment expecting that where rate will be after 3 months or after 6 months or after 1 year. And then based on that judgment, they have given that tenure expectation as well. So that is the missing piece. And also the credit component, like they have taken care of the credit risk involved in those when they are quoting 3 months or 6 months rates. But as I mentioned, that the LIBOR methodology is designed to produce an average rate that is representative of the rates which large and multinational banks could finance themselves through the wholesale unsecured financing market in their respective currencies. So LIBOR thereby inherently incorporates a bank credit risk component, which is absent from ARRs. So for any transaction that are converted from LIBOR to relevant ARRs, a spread adjustment to count for this embedded bank credit risk must be added to the ARRs to preserve the economics of the transaction. So hope you are getting it. If not, I can explain it later, or I can answer your question specific to this. So again, coming back to same thing, the differences. Let's understand from the perspective of 1:1. Like we want to compare the dollar LIBOR with the SOFR. SOFR is a selected benchmark rate or alternative reference rate for dollar, selected by the regulatory body, ARC. So in continuation to previous slide, what we have discussed, let's look at from a comparison of dollar LIBOR and SOFR. You can see the LIBOR, the first thing is bank lending rate, includes the credit risk. Like I explained, it's included a credit risk. And then in SOFR, we do not have that thing. So SOFR is a risk-free rate and just without any further component of tenor and credit risk component. Similarly, the LIBOR is forward-looking. However, the SOFR is overnight rate. And LIBOR is unsecured because there's no collateral involved when you are quoting a rate or making a contract out of LIBOR. Whereas SOFR is a secured rate, means it's based on a actual transaction happened, and it's also secured because it has a collateralized involved in that in shape of treasury bills. Again, the next point is LIBOR is calculated and published by a governing body, which is ICE, whereas SOFR is calculated and published by New York Fed. So similarly, SOFR, there is a SONIA for GBP. So SONIA is published by the Bank of England and the respective administrative bodies. So again, based on LIBOR, panel bank submit these LIBOR rates, and SOFR is basically on transactional basis, like I said. So if you see the volume involved, LIBOR involved roughly around $1 billion of transactions, and whereas SOFR involved 1 trillion of transactions. So it's an everyday transaction in US market where they exchange the collateral in requirement of their funding needs. So SOFR is based on 1 trillion of transactions. So this is a kind of a comparison just to understand that how much it is different from a LIBOR. So what we are replacing is very much different to the rate we are talking about. So moving forward, now we have discussed about the LIBOR, its transition, and why we need a transition, and how it will happen, and what are the alternative reference rates selected by the respective governing bodies. So now let's talk about what are the risks involved in this transition. So because we are risk people, we need to understand the risk, and we should talk about risk involved in every change is happening. So this is very important because every financial institute and bank or fund manager needs to know about their exposure and accordingly need to know the risk involved. However, it is not same for every organization because the risk types and the level of impact on firms will depend on the scale, breadth, and business mix of its operation. So basically, there are two types of risk involved. One is financial risk and other is non-financial risk. And as you can see, the respective risk under these two categories. I will not touch upon these separate categories because it requires a lot of time to explain the mechanics behind and why we are calling it valuation rate, why we are calling market risk. I think that OS can cover through its FRM courses very well. So if you are interested in learning those things, you must do FRM courses with OS. I think is the best teacher in those areas. So I will just talk about how these risks are important. So from operational and system risk point of view, we need to ensure that system and processes for all products currently referencing LIBOR must be updated to alternate reference rate. Like I mentioned, that what are the alternate reference rates? If you want to replace that rate, you have to replace in your systems end-to-end value chain. So further adjustment, like I said, the spread adjustment, other things will need to be account for ARRs calculated using the there's a term called compounded setting scenario. So that method I will explain in later part of this presentation. We'll talk about the quantitative part of it. So similarly, from a legal point of view, the existing loan and security which are referencing the LIBOR We need to identify effective legacy contracts and implement robust fallback prior to LIBOR discontinuation, because significant legal risk could materialize where the customer frustration and counterparty litigations are the key areas of concern. So especially regarding the cash market products and where you have a long dated contracts. We can discuss all these things at length, but that can be a separate session altogether. Like I said, so minding the limited time we have today, I will move forward. But before that, I will touch upon another risk, which is hedging risk. So because institutions with various hedged position exposed to LIBOR are exposed to basis risk as well. So again, this basis, what is basis risk? That is an other complete separate topic. So some other time we'll discuss about that. So moving forward, this is the uh, you can say the best practices I'm sharing here. This is a governance framework that can be adopted as a best practice to mitigate the risk we have just talked about involved in LIBOR transition. So it is very subjective to individual organization to adopt these according to the size and complexities of their operation and products. So now we come to the LIBOR reference products which are involved and their associated risks. So here you can see that list of products. You have $300 trillion derivatives, $15 trillion mortgages, $13 trillion bonds, syndicated loans, consumer loans, senior loan, floating rate loans, CLOs, securitization against mortgage-backed securities and asset-backed securities, non-agencies, mortgage-backed securities. So basically, there is a fallback risk challenge. Here you can see that products are more exposed to LIBOR transition, which are related, and some of the products are relatively immune to it, but not completely. Here, one product is a CLOs, that is a collateralized loan obligation, which is basically a single security backed by a pool of debts. So this is definitely the most exposed product to the LIBOR transition because of its complexities, and that is why the governing bodies and every regulator is asking institutions not to issue any further kind of these securities or products. Again, we can explore nature of all these products types in detail, but I will leave for another time. But if anyone is interested, I can explain this separately. Okay, moving forward, again, the same topic we have discussed, the spread adjustment to alternative risk reference rates, sorry. So the purpose of adjustment, as I said, that is to ensure the modified version of alternate reference rate should be the equivalent of the LIBOR or whatever IBOR we are talking about. So that spread adjustments should be there just to compensate the differential. And the ARC, which is the alternate reference rate committee recommendations for dollar, is that there should be a static spread adjustment methodology based on the historical median of the differences between dollar and SOFR or 5-year look back period. So ISDA has already selected 5-year historical median spread, and they have already applied to the derivative products. And one more important point is here is the credit dynamic credit sensitive rate. You can also call it spread. That can be added to SOFR, and it is mostly for the cash loan products. Okay, so now we are moving to the second last topic of our presentation. I'm just looking at the time if it's not too much time I've taken. So quantitative part is that how you calculate these SOFR rates or alternate reference rates. So there are multiple things you can do. You can have a daily rate, which is already there, published by the body. And then you can have a simple rate in arrears, which is average overnight rate during any interest period you are talking about. And then you have a compounded in arrears. So compounded in arrears is basically a suggested or recommended method by all the regulated bodies to use in risk-free rates, or you can say ARRs. So how it happens, I will just explain you by through the formulas and computation as well. But let's understand that this compounded daily overnight rates during the interest period will give you best of the differential in terms of, because as we had discussed that there's no term rate. I mean, this SOFR is only a overnight rate. So if you want to have a 3 months rate, 6 months rate, or 12 months rates, you don't have that component in this rate. So you have to calculate. And the recommended method by all the bodies, and even if you're talking about SOFR, the ARC has recommended that you should use a compounded in arrears method. But there is another method which is compounded in advance. So there is no difference of calculation, but it's a difference of taking a specific time period. Like in arrears means you are going back. You are going back with the same duration. If you are calculating a 3 month rate, so you are let's say you are calculating from 1st January to 31st March. So you have to compound a rate from 1st January till 31st March. And then after 31st March, you come to know that what is the compounded rate. Whereas compounded in advance is little bit more passive, which means that if you want to have a 3 months compounded rate in advance, you have to calculate uh, 3 months back. Like you have to calculate from October, November, December rates, and then you can quote it on 1st of January, let's say. So this is the difference between quoting a rate on a particular time after a contract is expired or before contract is start. So that is very, very important for the banks, even for all the financial institutions, because when you are quoting a rate and giving a rate to client should know beforehand that what interest he has to pay you in advance. So let's say he has to pay you 2% in next 3 months. So at the start of the contract, he knows that I have to pay 3%. But in this approach, compounded in arrears approach, he will not knowing that what rate he's going to pay. He will only know after the contract matures. Let's say from 1st January to 31st March. And then on 31st March, bank will tell him that, okay, this much of rate is this much of interest you have to pay. And that is the main obstacle, or you can say the main hurdle in defining the um, I mean the hedging problem with these kind of rates. Because if you do not know your cash flows in advance, you cannot hedge them. So if you cannot hedge them, it's a lot of risk you are taking. Depends on what kind of contracts you are writing with customer. Then the last thing is forward looking term, which is, I mean, thankfully, I mean, there is a mechanism going on. Basically forward looking term is exactly what is LIBOR, and for various tenors, and you know the rates in advance, that what is the next 3 months rate or 6 months rate or 12 months rate. So now the SOFR futures are traded at CME, which is Chicago Mercantile Exchange, and based on those future contracts traded, you have a future rate of SOFR. So it's a 3 month, 6 month, 1 month, 3 months, 6 months right now. So you can go to CME Group website. You can see that SOFR is published every day for all three maturities, and that is purely based on futures traded, SOFR futures traded by the counterparties. So now we come to the exciting, interesting part of calculation. So if we talk about a simple average of SOFR, which is daily SOFR. So if you have days like rates for first day, second day till the time period of time period, you have multiple rates, you can just have a simple average of them. So that is simple average of rates. So one interesting point is that to count the holidays, we use the SOFR on a previous business day. So let's see in this table, you can see that there's no rate on 7th and 8th March, which is Saturday and Sunday. So if you have to take that rate in formula, you can see that is the last rate of Friday multiplied by 3. That means you are taking the previous rate for next 2 days as well. And then the suggested method, which is compounded average. So how we calculate, there's a formula. You can see it, you can understand. I mentioned all the details, but let's look at from a data point of, for example point of view. So we have from 2nd March to 8th March, we want to calculate a 1 week rate. So you have a daily SOFR rate published, and again the same thing happens here, that you do not have any rate for holidays. So you'll take the previous rate. Here you are just compounding a rate. Okay, so in simple average, what is the difference between simple average and compounded average is because in simple average you can say that only principal incurs the interest. I mean, principal gets the interest accrual, but here in this compounded average, interest is also getting the interest. So that is how it is called compounded. So these are the two methods, but suggested method is compounded. And then you have to decide a look back period. So if you are talking about in areas, like I said in previous slide, in areas means you have to take a period during that tenor which you are talking about. If you're talking about 1st January to 31st March, then you have to take that look back period on 31st March, and then you can calculate a compounded rate. So similarly, if you want to have advanced rates, so you have to go back further. So this was the quantitative part. So now the last topic of our presentation is basically what is the way forward. So like we know that FCA announced the futurization, all the LIBOR rates, all 35 LIBOR benchmarks will be seized after 31st December 2021, with the exception of dollar. And FCA also announced that it will consider IBA to continue publishing 1 month, 3 month, 6 month dollar LIBOR on a non-representative synthetic basis. So basically, there will be a LIBOR after 31st December 2021, but only for dollar and only for selected tenors. And yeah, so that's where we are moving forward. So hope I have tried to cover all the aspects, everything in a very short span of time. But I understand myself that a lot of these topics or small details required further details or further discussion or explanation. But I think it is now good for everyone to understand that what is LIBOR, what is happening in the international market, and why we need to have a transition, and then how transition is happening.
No, Sajid, it was a wonderful presentation, and I think you covered things pretty well. We understand that there are certainly a lot of complexity involved, and this is such a wide topic that you cannot cover in 15 minutes, but I'm pretty sure that the participants would be able to understand what we wanted to. So if there are any questions, we'll be taking questions for next 5 minutes. So you can write your questions in the chat box and I'll be asking them. We have one question already. The first one is how the LIBOR influenced the LIBOR rate or lending rate in Pakistani context. Like, is there any relationship between the two?
No, I don't think so. There's any relationship. So because LIBOR, the mechanism is same. So LIBOR is also published by taking the rates from different panel banks, and then there is some methodology by Central State Bank of Pakistan, and then they publish that LIBOR on daily basis. So mechanism is same, but there is no relevance with LIBOR between LIBOR and LIBOR. There's two different rates for two different currencies.
Okay, right. So to sum it up all, basically there were some issues in the LIBOR rate. There were some collusion between the banks, and basically the participants were the main effectees because they did not have that sort of fair rate available.
Yeah.
So based on that, do you think the efforts that are going on, it will they will be able to avoid it altogether, or there would be some sort of, some sort of involvement by the bigger banks to still impact even the rates that will replace these rates. So what's your take on it?
Yeah, see, you are talking the same problem. The problem was that there was involvement of banks. So regulator don't want any involvement of big banks because they were rigging the rates for their own benefits. So the whole idea behind this transition is to avoid anything which can manipulate the rate. So that is why, so every currency is falling back to the original transactional base rates. Like we discussed that SOFR is a transactional base and collateralized, I mean, secured rate. So you cannot manipulate a lending through a transaction. You can manipulate a rate by suggesting that I see that in future, this rate would be this. But if you are doing a real transaction with other bank, so which is based on the requirement, so you cannot rig that eventually. So that is where they have put it. And there are certain issues. I mean, like we have discussed, there is no credit component, there is no tenor, there is nothing. But still, you cannot rig the overnight rate. That is the big idea.
Okay, all right, great. So there's another question that what is the impact of this LIBOR transition would be on fair value hedges?
Yeah. So that's I mean, that depends. I mean, what kind of a contract you have written with the customer. So if we talk about derivatives, that is why derivatives have the most affected, and that is why the ISDA, uh, which is the Derivative Association International, uh, they have come up with all the fallback mechanism, everything, even before 25th January 2021. So based on their defined mechanism, they have already implemented a fallback because they know that this is very sensitive in terms of derivatives. And in derivatives, you can have interest rate swaps, you can have forward rate swaps, you can have uh, any interest rate swaps where you have a moving rate like the floating rate, and then you are exchanging it with a fixed rate. So there is an implication. So there could be a P&L impact, which can favor customer at point in time, which can favor a bank at point in time. So that is why this litigation and this client frustration come into picture, because then client can sue you that you have promised me this much of return out of this hedging, because all these interest rate swaps and currency swaps mostly done because of the hedging purpose. So if there is a benefit to one party, so that would create an issue, legal issue. So that would be a big issue, I think.
Okay, all right. So I think we do not have any questions. Just an announcement before we end that we have started our session for the November 10th for the FRN preparation. We still have 2 free sessions which you can sign up. So if anyone of you is interested, you can drop me an email or contact me on my LinkedIn if you are connected, so we can have a chat on it. So in the end, Sajid, extremely thankful to you for taking your time, for making this very thoughtful presentation. I'm pretty sure that participants must have, gained a lot of knowledge. I have myself gained a lot of knowledge. I have some sort of clarity on where this LIBOR transition is going. We'll probably be putting this session on our YouTube channel as well, so I'll be sharing the link as well. So with this, I think we should be signing off. Thank you so much, everyone. Have a great weekend. Thank you.
Thank you, everyone. Thank you. Bye.